In this video, traders, we're going to look at lessons from Stanley Druckenmiller. Stay tuned. Hey guys, a warm welcome to you. Alright, so I've done probably a couple of videos on this before, but you know this channel is all about improving as a trader. And one of the things we do from time to time is study the great traders, and I kind of give a summary on here, maybe recommend some books and bits and pieces like that, because ultimately, guys, we are all trying to become better traders. And one of the things I like to do is look at some of the hedge fund managers, the money managers, the billionaires, and see what attributes, commonalities run between these guys, or maybe even unique attributes that are kind of there with these guys that we can take on board. I know that if I can take on board, and ultimately I'll try and share them with you so you guys can benefit from it as well. So that's my game, that's what I'm all about, that's what I'm trying to do. And some of the things that I've noticed from Stanley Druckenmiller when I was watching another video recently in an interview with him were very interesting. And some of the things he said before, but every single time these guys say something new, and you know, a lot of these kind of big players in the big titans, if you like, money managing world, are kind of at the end of their career, if you like. Most of them are still very active, of course, but you know, they're more now about these interviews and giving back and kind of sharing things than perhaps they were 20 years ago. So it's super interesting to learn from some of these guys. So anyway, without further ado, let's get on with it. So the first thing is, notice is that when something lines up, press hard. Now obviously he's a global macro guy, so he's looking from a position of when things are fundamentally shifting, then press hard. And he was saying that, you know, sometimes his fund was, you know, 100%, 200% even, pushed in. Now obviously for a big fund, that means that he's using leverage and doubling up his position. Now of course we've got to take it slightly differently as a kind of intraday trader, swing trader, position like we are. And we're using a lot more leverage, of course, because most of us probably have less than multi-billions to manage in our spread betting account or CFD account. But the point is that, okay, when things are lining up, push the chips in. He gave an example of, I think it was when Trump won the election, he recognized that, hey, things have fundamentally changed and it was time to get very aggressive on his position. And he went very aggressive on it, and he kind of made a joke about, he rang Paul Tudor Jones and he was saying, swearing at him, saying this is the time, this is the time. Anyway, the point is, guys, is from our perspective, yes, we're probably not trading on a global macro perspective. We're trading more technical, and Paul Tudor Jones is more technical as well. Perhaps not kind of the level that we are, but he uses a lot more technicals, as he said, when he was interviewing Stanley. So he basically, the kind of takeaway from this, guys, is that when we've got a grade A setup or grade A plus setup, leading setups, if you don't, then what we're trying to do is trying to find the very best setups and how we identify those. Those ones are the ones that we take a little bit more risk on. We tend to prepare to take more risk on. George Soros talked about it. Other hedge fund managers have talked about it. Some don't agree with this, which is interesting, but many do. So listen, when it's right, you go in, you put a lot of commitment into it, because the opportunity's there, the asymmetric risk is there. You want to really be going heavy and pressing when things are right. So when you've got a setup that's right for you, and that's going to be a rare setup that ticks all the boxes, then maybe you allocate more risk to it. Maybe you do kind of really push stuff in and allocate maybe 5 or 6 days worth of risk to the trade that you wouldn't otherwise normally do. Now obviously he's pre-prepared. He's not just shooting from the hip here and just slamming loads of size on because he feels like it, but he will have decided, hey, when things are lining up, we want to really press it. And that's super interesting. Number 2, only close your position when your thesis is no longer correct. He doesn't use stops, but what he says is, hey, if my thesis is no longer correct, I will close it. I've had drawdowns of $1 billion in a day. I haven't closed it because my thesis has still been correct. So how does that translate to the technical trader like you and I? Well, fundamentally it means that, hey, we should have our stop loss in a position where the thesis is no longer correct. So no tight stops. If you're buying a dip, then where's the stop going to be? Well, it's going to be where it's no longer a dip and it looks more like a reversal. Example, if you're buying a bull flag, it's going to be where it's no longer a bull. You get the point. The idea is the thesis is there. The exit position, whether it's a stop or it's just a mental exit, is where the trade is no longer correct or valid. And the big one here, guys, is being able to sit through drawdown when the thesis is still correct. Now, let me just qualify that. That doesn't mean sitting there and just hoping, thinking, well, thesis is still correct. It means accepting that in certain setups, you may well have to sit through drawdown if your thesis is still correct. And if you don't like it, don't take the setup. Now, he didn't want to sit through billion-dollar down days. Nobody does. But he knew that it was something he had to do because the thesis was still there. He's also said stuff where, hey, I've cut things quite quickly because the thesis changed literally the next couple of days. And so it just shows you that it's all about trading your idea, whether it's technical, whether it's fundamental, it's global macro, whatever it is. It's about trading around that and not about trading your P&L. Billion-dollar down day, cut it. No, the thesis is still there. I'm going to have to sit through this and whatever happens, happens. Maybe you had a 500 grand down day and cut it because the thesis was changed. The point is it's aligning yourself with that. And so, you know, I talked about another video, it's probably been uploaded now. I talked about, okay, different level obviously, but talked about having to sit through a 50-point pullback on trading heavy down days because that's just the way it is. If you're looking for that press into the close, you're going to get these sharp bounces. And if you're not prepared to sit through those and not prepared to have the size that allows you to sit through it, then you don't trade it because you're going to get taken out based on your P&L, not when your thesis has changed. So, you know, it really does kind of have a parallel to our type of trading as well, guys. Right, number 3, put your eggs in one basket and watch it. I'm sure Warren Buffett said this as well, but again, this is personal style and preference. You know, look at someone like Ray Dalio, he likes the diversification, having allocated assets in different kind of pots. But the Stanley Druckenmiller likes to just go heavy on one thing when he's right and just watch it like a hawk. I think I like that idea better than diversification. You probably are maybe similar, but there's probably some people out there who've got a kind of portfolio of stocks as well and like to diversify. But many traders are a little bit more aggressive and kind of pushing heavily on an idea of, say, long indices or, you know, short commodities or whatever it may be, and getting aggressive around that idea. So that was interesting. Number 4, think like a chess player. So he didn't say this per se, but the way he's talking is he's thinking, you know, 5 or 6 moves. So, you know, in the global macro, he's saying, okay, well, you know, if interest rates do this, then the Fed chair might well be this. If Trump gets in, then he might choose this. And if that person does this, how are they going to respond to Japan? How will Japan respond to Eurozone doing this? You know, he's thinking, and this is literally just off the top of his head. I imagine when he's in deep thought in the boardroom or wherever he's doing it, he goes even further with it, looks at all the different parameters. So, you know, from a kind of short-term trader's perspective, guys, it's thinking, who's the next person who's going to buy this to make it go up after I bought it? How are people feeling? You know, what's the position of them? Are they trapped? And it's kind of thinking, you know, a bit of a chess game. Number 5, take the difficult trade. This is something that I've heard many money managers say. You know, the hard trade is often the best trade. The trade that seems the craziest is often the best trade. Say from a technical perspective, you know, that flush, that big hammer flush to lows, everyone's, you know, vomiting up their long position, is often the time when, you know, you're buying it and you're capturing, you know, a very nice gain. Number 6, find a way to express your thesis. Perhaps not so useful for us because our way to express our trade is normally to trade via a spread bet, CFD. If you just contract a stock, maybe an option, you haven't got much selection there. But on a global macro perspective, if he thinks perhaps interest rates are going to rise in a country, then the bond would be the obvious one, but then maybe the currencies are the play, or maybe you know, a specific group of equities is a better play because they're going to be more vulnerable to that. So, you know, whilst it's not quite as useful to us as some of the others, it's still showing the thought process of, well, I'm not just going to go straight away and trade that idea. And we could take something away from this as well, guys. We could say, right, well, if you're trading, you know, let's say you're trading gold, for example, and you see gold technically breaking out of a position, and perhaps the correlation with silver has been quite high recently, maybe you're expressing the gold strength in a silver play. So even, you know, you could say, well, actually, you know, that's my thing, I'm watching that, I'm trading that, I could trade that directly, but perhaps it's a proxy trade. Perhaps I'm trading a laggard in a sector. You know, is there something else that's not quite a kind of direct play? So maybe there's something to be thought about from that aspect, but super interesting. Anyway, guys, all these things here I think are really interesting. Like I say, I like studying some of these great money managers because if we can take 1 or 2 little bits and implement them in our trading, we're only going to improve. And if I can share them with you guys as well, then you guys are going to improve as well. And that's what it's all about. Anyway, guys, take care. I'll see you in the next one. If you like this kind of stuff, you know, thumbs up is much appreciated. And if you are a subscriber, again, appreciate your support. If you're not, why not? You may as well subscribe now, because we've got more stuff like this coming, loads of videos in the library, and we're just all trying to become better traders. So take care. Bye bye.